Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we are doing a deep dive into the really complex landscape we're seeing in the markets. This is Wednesday, November 19, 2025.
It really is.
And looking across headlines from CNBC, Bloomberg, and Reuters, you see this clear tension. There's a severe global tech sell-off that's challenging all that AI euphoria.
And at the same time, everyone is just holding their breath for this critical, delayed U.S. macro data.
All against this backdrop of, well, really fluid geopolitical supply chain conflicts.
It's a market that feels like it's being pulled in two completely different directions. On one hand, you've got this, revolutionary optimism around the AI trade. Private capital is just flowing in almost without limit.
Right.
But the public market is dealing with a pretty profound crisis of faith, especially on valuations.
I'm trying to price a future that might not even materialize.
Or at least not at the speed the market needs it to. And all of that is happening while we're navigating these huge shifts in U.S. interest rate expectations and, dealing with this unavoidable reliance on China for global resources.
Okay, let's unpack that. Let's start right where the pain is most acute. The AI valuation crucible. We've seen a pretty noticeable trend reversal.
We certainly have.
I mean, just looking at the major indices, the S&P 500 logged its fourth straight decline. I was reading on Yahoo Finance, that's the longest slide we've seen since August.
And the NASDAQ, the tech-heavy one, is down in 5 of the last 6 sessions. The market is clearly nervous.
And that nervousness, it really boils down to one name today.
It absolutely does.
Yeah.
NVIDIA, their Q3 earnings are due after the close, and the expected volatility is just unprecedented.
What are we talking about here?
Well, based on options trading, analysts are expecting a potential move of up to 7% in either direction.
7%. For a company that size, that's just massive.
It's a swing of over $320 billion in market value. And that doesn't just affect NVIDIA, it hits the entire chain, from the smaller AI stocks all the way to its main competitor, AMD.
That level of volatility really makes you wonder if the great AI rally is finally facing its reckoning. I mean, we have two very distinct camps on this. Let's start with the bulls.
The optimists, folks like Fidelity International's Joseph Zhang, they are steadfast. According to a piece in Bloomberg, Fidelity really believes this rally is going to persist.
And their reasoning is
that AI, capital spending, and user adoption are just happening at an exponential pace. Zhang argues that we're so early in this whole technological shift.
So any corrections are just noise.
Exactly. He sees them as liquidity-driven, not structural. And so for them, they're buying opportunities. He had that great quote, "It's still in the early stage of the party."
But the skeptics, well, they have some pretty powerful evidence on their side, especially around how big tech is funding this whole ecosystem. Jim Cramer, for instance, he noted that the red-hot AI trade turning cold really kicked off back in September.
Yes, that Oracle earnings report, which CNBC highlighted, that was the first real, concrete sign of trouble. Because it revealed that Oracle's massive cloud computing backlog was overwhelmingly tied to a single customer. OpenAI. And that immediately raised concerns about the scale, the sustainability of OpenAI's rumored spending.
Right.
I mean, there are fears it could balloon past $1.4 trillion just for compute power.
And the public suddenly had to ask, wait a minute, who is paying for all of this?
Precisely. And that leads directly to this concept everyone is talking about now, circular investment. Or circular economics. It's really putting off public investors.
Can you just clarify what that dynamic actually is?
Sure, it's a crucial point. Circular investment is when the investors who are funding the AI ecosystem are also the largest customers driving the revenue. So we saw a perfect example of this. Microsoft and NVIDIA together committed a combined $15 billion into the AI startup Anthropic.
And in return?
In return, Anthropic commits to buying its compute power. So, chips and cloud services from those exact same investors.
So the revenue growth that the hyperscalers are citing, it isn't really coming from organic external market demand. It's a closed-loop system where they're basically paying themselves through a third party.
That's exactly it. And critics argue it creates this illusion of demand. I mean, sure, it drives these massive valuations for the startups. Anthropic is now valued at $350 billion on this deal, but it makes public market shareholders incredibly suspicious.
Because they're worried the whole foundation of the AI revenue stream is just internal financing, not real, independent customer growth.
Right. And this brings us to what might be the most fundamental challenge covered in the sources, which is this complete transformation of big tech's DNA. This insight came from an analysis by Carlyle.
This is a really interesting point for long-term investors.
It is. Carlyle's Jason Thomas highlighted that big tech, the U.S. hyperscalers, they used to be the definition of asset light.
Money-printing software companies.
Exactly. Their main assets were intellectual property, which allowed them to have these extremely high price-to-book ratios. But now, because of AI, all the data centers, the cooling, the energy infrastructure, they've morphed into heavy infrastructure companies.
So what are the numbers on that?
Thomas pointed out that big tech's capital spending now eats up 70% of their operating cash flow. And here's the real kicker. 70% of their book value is now property, plant, and equipment, physical data centers.
Wow.
That ratio has quadrupled in just a decade.
So if your whole valuation formula relies on a high price-to-book ratio that reflects intangible assets, but now 70% of your value is tangible physical stuff, what does that mean for the stock price? Does this physical change actually matter to shareholders, or is it just an academic point?
Oh, it absolutely matters. Infrastructure companies, think telecoms, utilities, they trade at much lower multiples. They have high maintenance costs, fixed assets.
So the market is trying to price a tech stock using an infrastructure playbook.
And it's struggling. It's trying to reconcile this enormous short-term capital spend with the long-term promised profits. That's why we're seeing all this turbulence ahead of earnings.
That is a fantastic way to frame that tension. Okay, before we leave the world of corporate balance sheets, let's look at how geopolitics are impacting the physical components these data centers need. There's a pretty significant de-escalation story on chips coming out of Europe and China.
Indeed. This is coming from reports in both CNBC and Bloomberg. The Dutch government, pretty surprisingly, suspended its intervention at Nexperia.
That's the Chinese-owned chipmaker.
Right. They returned full control to its owner, Wingtech. And it was framed as a show of goodwill after some successful talks with Beijing.
And just for context, the Dutch had used a Cold War-era law back in September to seize control. The idea was to safeguard crucial legacy chip technology.
Right, the older, bigger chips that are still absolutely vital for supply chains, especially in the auto sector.
And China immediately hit back.
They did. They blocked exports from Nexperia's facility in Guangdong. So this de-escalation is a massive relief for automakers like Honda and Volkswagen who rely on those specific chips for their legacy lines, which are still very profitable.
So the risk of shortages has receded, at least for now.
For now. But this de-escalation on legacy chips is in really sharp contrast to the long-term structural vulnerability Europe faces with other critical materials, specifically rare earth elements.
Which CNBC had a big piece on.
Yeah, and the vulnerability is profound. Europe is almost entirely reliant on China for rare earth magnets.
And these magnets are in everything.
Everything. The motors in EVs, generators in wind turbines, and yes, the cooling and power distribution systems in those sprawling new AI data centers.
China's dominance isn't just in mining, right? It's the entire process.
It's the entire value chain. They handle 59% of global mining, 91% of the refining, and 94% of the actual manufacturing of permanent magnets. It gives Beijing incredible leverage.
And the EU knows this. They're trying to pivot with this Resource U plan, boosting domestic production, partnering with places like Canada and Ukraine. They even opened Europe's first magnet plant in Estonia recently.
And those are necessary steps, absolutely. But the timeline to achieve any meaningful independence is just long.
Years, not months.
Exactly. As European Commissioner Valdis Dombrovskis noted, diversification will take years. The EU faces these long approval processes, extremely strict environmental standards, the green tape that China just doesn't have to deal with. The hard truth is Europe treated raw materials like a simple commodity for decades, and reversing that is an incredibly challenging multi-year project.
Okay, let's move from geopolitics to macro currents. Looking at the U.S. Financial Watch, the market is still trying to catch its breath after the prolonged government shutdown.
It is. According to CNBC, the 10-year Treasury yield is holding steady near 4.117%. And while that seems like just a static number, it's so important.
Because it sets the baseline for the entire economy.
Right. It sets lending and borrowing rates. And a steady high yield like that, it just dampens the appetite for risk assets. Why take a risk when you can get a decent, reliable return from a risk-free government asset?
And speaking of dampened risk appetite, we have huge data releases coming up tomorrow. The delayed October trade balance and the big one, the September non-farm payrolls report.
And that uncertainty is exactly what the market hates. But today, the immediate focus is on the release of the FOMC minutes.
Everyone will be picking those apart for any signals.
Absolutely. And the messaging from the Fed has been decidedly mixed. Fed Governor Christopher Waller, he emphasized that labor market conditions are paramount for any potential December rate cut.
So what are the markets pricing in now?
Well, the expectations have really been dampened. You look at the swaps market, investors are now giving it only about a 50-50 chance of a December rate cut. The labor market, despite the shutdown, is just too strong. It's pushing out that timeline for relief.
That tightening macro backdrop brings us squarely to risk assets, and Bitcoin has been suffering severely.
Yeah, Bloomberg is reporting that the digital currency has fallen nearly 30% from its 2025 peak.
And the key metric here is that $90,000 price point.
It is. Bitcoin briefly dipped below that mark on Tuesday, which is a critical psychological level because it means the typical investor in the major U.S. Bitcoin ETFs like BlackRock's IBIT is now collectively sitting on losses.
And we saw the fallout immediately.
We did. BlackRock's IBIT saw a record single-day outflow. $523 million on Tuesday alone. That contributed to over $3 billion in total November outflows across all the U.S. Bitcoin ETFs.
So that whole narrative of Bitcoin as an inflation hedge or a portfolio diversifier?
It's really under pressure. The Bloomberg analysis shows Bitcoin is lagging way behind gold and even long-term U.S. treasuries right now. The supposed digital gold is just failing to act like gold in this kind of unstable environment.
Before we leave the U.S., we have to loop back to that initial AI theme and its incredible energy demands. A report on CNBC shows this demand is now literally reshaping energy policy.
It really is. A perfect example is the U.S. administration providing a massive $1 billion loan to Constellation Energy.
And this loan is specifically to restart the 3 Mile Island nuclear plant,
which is being rebranded as the Crane Clean Energy Center. And the power from this huge nuclear facility, it's already secured, a 20-year purchase agreement.
With Microsoft.
With Microsoft. This just perfectly illustrates the scale of AI's footprint. Microsoft is basically providing the financial backing to restart a nuclear plant, all because it needs to power its data centers. AI demand isn't just an abstract price concern anymore. It's directly driving capital for new, heavy infrastructure energy projects.
Okay, let's move to our final section, Asia. We're seeing some fascinating contradictions in the flow of global capital. Hong Kong, for instance, despite all the headwinds, is having a pretty significant IPO boom.
Yes. According to both CNBC and Reuters, the Hang Seng Index is up over 28% year to date. That's boosting some much-needed investor confidence.
And this is important because Hong Kong is becoming a critical exit valve.
It really is. For private equity firms that have been sitting on aging China assets for years and need a way to realize their returns, investors are starting to see Chinese consumer assets as growth at a discount, especially if they're sheltered from all the geopolitical tech fights.
So while some capital is moving out via IPOs, China is aggressively expanding its soft power. And they're doing it through cultural exports, especially gaming.
This is a huge growth area that CNBC identified. NetEase had a new martial arts game where wins meet.
I saw that.
It saw over 2 million players globally within 24 hours of its overseas release. And that success is attracting serious foreign strategic investment.
Like from sovereign wealth funds.
Exactly. Executives from Saudi Arabia's Savvy Games, which is owned by the massive Public Investment Fund, or PIF, they were just in China actively investing in major esports leagues like Honor of Kings and League of Legends.
So the PIF's interest shows this isn't just about entertainment, it's strategic.
It's absolutely strategic capital deployment into a high-growth sector where China is dominant. They're positioning themselves for long-term growth by leveraging Chinese content.
Now, let's tie this all back to the U.S. one last time. There's a really surprising data point from AData on global Chinese lending. Despite all the talk of decoupling.
All the talk of pivoting supply chains.
The United States is actually the single largest recipient of Chinese lending, globally.
This is the ultimate geopolitical paradox we found in the source material. AData reports the U.S. has received over $200 billion in Chinese lending.
$200 billion.
Spread across nearly 2,500 projects. And this isn't consumer debt. This money is focused directly on critical U.S. infrastructure and high-tech supply chains.
What kind of infrastructure are we talking about?
We're talking about funding for liquefied natural gas facilities, massive data centers in Northern Virginia, which loops right back to our AI discussion, and terminals at major U.S. airports like JFK and LAX.
Unbelievable.
On top of that, Chinese state-owned creditors have provided credit facilities for many Fortune 500 companies: Amazon, Tesla, General Motors. It suggests that while governments talk loudly about decoupling, the financial ties at the infrastructure level aren't just stable, they're actually deepening. It just shows the sheer impossibility of an immediate, total split.
So what does this all mean for you, the listener? The world today is really caught in this profound conflict. You have undeniable technological progress, this massive multi-billion-dollar AI spending, fighting against severe market uncertainty that's driven by valuation corrections and macro instability.
And that short-term dip in global equities, that's the real stress test. It's testing the conviction of all those long-term AI believers. Meanwhile, you have global supply chains attempting this complex multi-year pivot away from China, a move that will take years and immense political will, even as Chinese capital continues to be deployed deeply into U.S. physical infrastructure.
But the structural shift in big tech, from these money-printing machines to heavy infrastructure companies that demand colossal, continuous capital, that $1 billion nuclear plant deal with Microsoft is the perfect example. That's the single most significant story here, and it begs a fundamental question.
A really fundamental one.
If the cost of building this AI future remains so astronomical, how long can investors possibly sustain these current valuations if the massive promised returns lag behind the immediate and just enormous cost of building the foundational infrastructure? And with that, we'll see you all tomorrow morning with new headlines from major financial magazines.